Hey, welcome back to Compounding Quietly. Adding growth to a dividend portfolio sounds like a logical upgrade, but an upgrade toward what? That question stops most investors before they reach a useful answer. Let's think through this clearly. There is a moment almost every dividend investor reaches, and it tends to arrive quietly. The portfolio is working, the income is growing, the strategy feels solid, and then they look at a growth ETF's performance over the past few years. Suddenly, the dividend portfolio feels slow. Not broken, just slower than what they just saw. And that comparison creates a very specific kind of discomfort. Most investors at this crossroads do not question whether their strategy is wrong. They question whether their strategy is complete. That distinction matters more than it sounds, because my strategy is incomplete tends to push investors toward adding something fast. And fast usually means before they have worked out what that addition is actually supposed to accomplish. Growth ETFs have had strong stretches of performance in recent years. The numbers are visible and easy to find. Community discussions reinforce the idea that missing out on growth is a mistake. And when that kind of narrative surrounds you, the pull becomes hard to ignore. But here is what that pull is actually made of. It is not evidence that your current strategy is failing. It is a comparison between two things that were never trying to do the same job. A dividend portfolio is not built to keep pace with a growth ETF during a bull market. It is built to generate a growing income stream compounding over time, with stability that pure growth strategies don't offer. When you compare trailing price returns between a dividend portfolio and a growth ETF, you are using the wrong ruler. They were aiming at different targets from the start. So before asking whether to add growth, the more useful question is this: what is this portfolio for? What job is it supposed to do, and for whom at this point in your investing life? Because once that question is answered clearly, the question about adding a growth ETF becomes much easier to reason through. Let's start with accumulation, the phase where you are still building, not yet drawing income. In accumulation, total portfolio value matters alongside income growth. The larger the base you build now, the larger the income stream that base can eventually support. Yield on a small base is a small income. Yield on a large base is a meaningful income. That is the mechanical reality of the strategy. A growth ETF, in this context, brings something. A dividend portfolio doesn't prioritize price appreciation, not yield, not quarterly distributions, but growth in the total size of the portfolio itself. Think about an investor in their late 30s. They hold a dividend core quality companies, or ETFs designed to grow income steadily over time. Their horizon is long, maybe 25 years before they plan to draw from the portfolio. For that investor, adding a growth position is not a contradiction. It is not an admission that dividends are insufficient. It is adding fuel to the base that the dividend strategy will eventually run on. The dividend allocation builds reliability. The growth allocation builds scale. Used with a defined percentage split and a fixed annual review, they serve the same long-term outcome. The phrase that matters most there is defined rules, not "I will add more growth when things look favorable," not "I will reduce growth when it drops." Those are emotional responses dressed as decisions. A criteria-based approach sounds different. It says, growth represents a fixed share of the total portfolio. I review it once per year on a date I have already chosen. I adjust based on life phase, not based on what the market did last month. That is the version of adding growth that holds up over time. Not because growth ETFs are better than dividend ETFs, because the rule removes the decision from the moment of highest emotional pressure. And in investing, the moment of highest pressure is almost always the worst moment to decide. Now let's move to distribution, the phase where income is already being drawn from the portfolio. Here the calculation changes in a meaningful way. In distribution, consistency matters more than acceleration. Growth ETFs carry higher price volatility and tend to produce less income than dividend-focused holdings. Adding one to a portfolio that is already being drawn down introduces sequence of returns risk. This risk appears when a correction forces you to sell more shares than planned, just to cover expenses. Once those shares are sold at a loss, they are not there to recover when the market comes back. Picture an investor who recently retired and added a growth ETF alongside the dividend core. The logic felt sound. Capture some upside, let the portfolio keep growing. The dividend income arrives reliably each quarter. But then a correction hits, and the growth position drops significantly. That investor is now watching one part of the portfolio deliver steady income, while another part shows a notable loss. The emotional response that follows is predictable: doubt, discomfort, the instinct to sell the losing position, simplify, and stop the uncertainty. And that decision, made under that kind of pressure, is rarely the one the investor would have made in a calm moment. That is the real cost of adding growth without a defined purpose. Not the drawdown itself, but the drop in decision quality that comes when the discomfort peaks. A position without a clear reason for being. There is the first one that gets cut when things get hard. And when it gets cut under pressure, the original logic rarely survives the exit. This brings the title question back into focus. Does adding a growth ETF to a dividend portfolio help? In accumulation with clear allocation rules and a long enough horizon, it can add real structural value. In distribution without a specific, defined role, it often adds complexity without adding clarity. The difference between those two outcomes is not which growth ETF you chose. It is the criteria behind the decision to add it in the first place. Let's pull back to the structural question underneath all of this. Every holding in a well-constructed portfolio should have a job, a specific, clearly defined job, not a vague sense that it probably adds value, not a feeling that the portfolio looks more complete with it included, a specific role with a specific logic, and a way of knowing whether it is doing that role. The dividend ETF's job is to grow income over time, steadily, through market cycles, without requiring constant adjustment. The growth ETF's job is to grow total portfolio value, accepting higher short-term volatility in exchange for greater long-term appreciation. Those are compatible jobs. They are not the same job. A portfolio that holds both without clear priority will eventually feel like it is underperforming at both. Not because either holding is wrong, because the purpose behind them was never decided. This is what most discussions about portfolio construction miss. They focus on which ETF is performing better, which one has stronger trailing returns. But better at what? For which investor? In which phase? The clearest investors are not the ones with the most optimized allocations. They are the ones who can say, without hesitation, what each position is there to do, and under what conditions that role would change. That clarity is not a natural talent. It is a decision made in advance, before the market creates the pressure. The question was never whether growth outperforms dividends over a given period. Both can compound quietly over time when used correctly. The question is whether the addition serves the portfolio's defined purpose, not the market's current mood. That is the only answer that holds when the pressure arrives. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.